Ever wondered how the stock market works? The stock market, often seen as a complex web of numbers and graphs, is actually a dynamic financial system where buyers and sellers trade shares of publicly held companies. The stock market is divided into two main segments, the primary and the secondary market. The primary market is where companies issue new shares through initial public offerings, or IPOs, to raise capital from investors. The secondary market, on the other hand, is where existing shareholders trade previously issued shares. Key players in this financial theater include individual and institutional investors, public and private companies, as well as intermediaries like brokers and market makers. Each plays a unique role in the vast ecosystem of the stock market. Now, you might ask, what determines the price of a stock? Well, it's a combination of factors. Supply and demand is the primary driver. When more people want to buy a stock than sell it, the price rises. Conversely, if more people want to sell, the price falls. Other factors include a company's earnings and financial performance, economic indicators, and market sentiment. Stock exchanges like the New York Stock Exchange and NASDAQ are the platforms where the buying and selling of shares occur. They enforce rules and regulations to ensure fair and transparent trading. Regulatory bodies like the Securities and Exchange Commission in the United States oversee and regulate the market. To get a snapshot of the market's overall health, we look at stock indices such as the S&P 500 and Dow Jones Industrial Average. These indices measure the performance of a specific group of stocks and serve as benchmarks for investment performance. Now, when it comes to investment strategies, there are several approaches. Some investors opt for long-term investing, buying and holding stocks with the expectation of long-term capital appreciation. Others prefer day trading, buying and selling stocks within a single trading day to profit from short-term price fluctuations. Then there are value investors who seek out stocks they believe are undervalued based on fundamental analysis. And finally, there are those who use technical analysis, analyzing historical price charts and trading volumes to predict future price movements. But remember, with potential rewards come risks. These include market risk, company-specific risk, and liquidity risk. The possible rewards: capital appreciation and dividends. Finally, to ensure the stock market operates fairly and transparently, regulatory bodies like the Securities and Exchange Commission in the United States oversee and regulate the market. So there you have it, the stock market in a nutshell, from how it's structured, the key players, how stock prices are determined, to the risks and rewards of investing. It's a fascinating world, one that plays a crucial role in the global economy.